In this Investing for Beginners video, I'm going to give an explanation of stock market order types that you should know when buying or selling a stock. Some stock market order types are created for speed of execution, whereas others aim to achieve a specific price. Knowing the difference between these stock market order types is fundamental to investing. So in this video, I'm going to go through some of the main stock market order types. I'll explain what is a market order, what is a limit order, and what are stop orders. If it's your first time watching my channel, then my name's Ollie, and on this channel we discuss all things related to personal finance, saving and investing. So please don't forget to subscribe, and if you get any value from this video, then I'd really appreciate an early thumbs up, as it helps the channel massively to reach more people. Now, before we get stuck in, I must be clear, I am not a financial advisor, and nothing in this video is intended to be financial advice. And if you want financial advice, you should seek a licensed professional. At the end of the day, I am just a random guy on YouTube, so you should always do your own research, because this video is just for entertainment purposes only. So now that's out of the way, let's get stuck into the video. So bear in mind, not all brokerages allow all of these order types, so it's best checking with your broker. And it's also worth noting that sometimes different brokers use slightly different names, and I know a lot of you follow me for my Etoro content, and they use slightly different names and concepts on there. So if you want information regarding eToro's order types, then I have an eToro specific video which you can check out up here, and then there is another video I have for eToro's take profits and stop losses, so the link to that is up here also, and both of these videos will also be put in the description below. So the first stock market order type I will explain is a market order. This is the simplest order type, and you're basically saying to your broker, I want to buy a stock right now at whatever the going market price is. If you are going to buy a stock, then most of the time you will pay at or near the posted ask price. Similarly, if you are selling a stock, you are saying, I want to sell this stock now at whatever the going market price is. Most of the time you will receive a price at or near the posted bid price. Now, the reason that I've said most of the time you will receive a price at or near the ask bid price is because the last traded price is not necessarily the price at which your market order will be executed. In volatile markets, the price at which your order is filled can differ, and the split seconds from when you press the order button to when an order is filled, the price may move. But market orders on stocks that trade over tens of thousands of shares a day will generally be executed close to the bid or ask prices, but there becomes more risk with penny stocks or low liquidity stocks. So an advantage of a market order is that you are guaranteed to get the trade filled, but the trade-off is you don't know the exact price at which the stock will be bought or sold. Investors making market orders tend to be more interested about receiving the shares now than the price. One thing that's worth noting is if an investor places a market order after market hours, then the price could be very different when the order fills at market open. The next stock market order type I'm going to explain is a limit order. These allow investors to buy and sell stocks at a specific price. So basically, with a buy limit order, you are saying, I want to buy a stock, but there's a limit to the price I want to pay. This type of order only executes when a specific price is reached, and the order will not be filled if the price does not reach this level. Similarly, on a sell limit order, there is a limit on how low you will sell a stock for. So basically, you are saying you will sell it for this price or higher. So in effect, a limit order sets the maximum or the minimum price that you are willing to buy or sell a stock at. Obviously, the benefit of this is that you get to pay the price you want to. So these are good when you think a stock is only worth a certain amount and don't want to pay anything more. But the downside is that your position may not open if the market goes in the opposite direction. Or if your order does fill, it may not fill quickly, or your order may only be partly filled if the price moves away from your limit price. So to see a quick example of this, so say a stock is around $15, but you think it's only worth $10, it could be going up and down like so, and then you can put a limit order in for $10. So while it bounces around here, it won't execute, but then if it hits this $10 here, you will get it at $10. It may carry on going below, but you've now got in, and then say it bounces back up, you've got your share here at $10. So the next stock market order type I'm going to explain is a stop order. And these can be broken down into 4 subparts. And these are basically a market or limit order that remains dormant until a certain price is passed and an activation price triggers the order. So buy stop market orders and buy stop limit orders open a new position, whereas sell stop market orders and sell stop limit orders close you out of a position. So firstly, a buy stop market order will place a market order once the stop price has been reached. So as an example of a buy stop market order, say a stock is trending around $100, but we may want confirmation it's trending upwards. So we can then set a stop price at 110. Then when it reaches this price, it will execute a market order. So for example, it could be going up and down here, and then we want confirmation. And then as soon as it reaches 110, it will now execute a market order. And so then our order will be placed. And similarly with a buy stop limit order, this is an order to purchase a stock at or below a specified price, and will place a limit order once the stop price has been reached. Hypothetically, say a stock is trending around $100 again. We may not want to buy in yet, as we want confirmation that the stock is trending upwards. So we can set a stop price at 110, but we don't actually want to buy the stock at 110, so we set our limit price at 105. So that way, if the price pulls back, we can get in at a better price. So for example, it could be going up and down like this, and then eventually we know that this is trending upwards, and then it hits our stop price of 110, and then we don't want to buy at 110, but then it comes back down, and then when it hits 105, our limit order executes. And now we have the inverse of this with a sell stop market order and a sell stop limit order. So what is a sell stop market order? This is an order to sell a stock at a specified price, similar to a buy stop market order. But in this case, once the price drops to a specific point, it will create a market order to sell your stock. So say a stock is currently riding around $100 and we have a sell stop market order for $90, well, then it would cash out my position if it hit $90. So it could be going around here like this. So at this point here, our sell stop market order will execute, and if this carried on going down, we would have prevented against any additional losses. You should also be careful at what price you set for your sell stop order. If the market is volatile, you don't want a stop loss to cash out your position only for the market to go back up again, because say for example this went like this and then carried on going up, well then you've now sold your stock and this could keep going up and up and up. But you can try to help prevent this with a sell stop limit order. So what is a sell stop limit order? Again, this is an order to sell a stock at a specified price, similar to a sell stop market order. Once the price drops to a specific point, then it will trigger a limit order to sell at your limit price. So say we have a stock hovering around $100, our stop may be at $90, but then we set our limit to $85, so it won't sell our stock for anything less than $85. So with a sell stop limit, there would be 2 prices you key in, the stop price and the limit price. So for example, this could be going up and down here, and then eventually it goes here, but it doesn't sell as soon as it hits that, and it could go back up again, and then it could even go all the way above here, but then eventually it does come back down, hits 85, our limit order was activated here, but our limit order doesn't sell until it reaches here. So sell stop market orders help an investor get out of a position falling quickly, but the risk is that the next available price may be lower than anticipated. Whereas if an investor uses a sell stop limit order, when the stock falls, it will trigger an order that it seeks to fill at a limit price or better. Obviously, the benefit of this is you get to say the price at which a stock is sold, but there's a risk the order is never filled. So stop orders are helpful if you don't have time to watch the market all day long. Sell stop orders are a type of stop loss where you are stopping a potential loss, and these are great if you want protection from large downward movements. They can also help you cash in profits. It's worth bearing in mind that prices sometimes gap or jump past specific prices, which may affect limit orders. This doesn't happen very often, but is something to be aware of. It's more likely to happen on prices moving in after hours or pre-market trading. So if I show you a quick example again, say we have a limit order set to 50 and say the price is going down here and we're reaching the end of the day, and then we hit here at the end of the day, so that's, I don't know, 60. Then in extended hours, it may carry on and then go right down, and then we open the next day at, say, I don't know, 25 here. Well, that's then missed our limit price, and so our order will not have opened. And then if we look at a real world example here, you can see with Tesla on the 1-day chart, for example, this has finished the day here around 742, and then on the next day it's opened up at 765. So that's gapped over those prices in between. Now there are a few other stock market order types and some other options you may have when placing stock market orders. Firstly is the expiration of the order. So here you may see day or GTC. So GTC means good till cancelled. This is basically saying you want to keep the order active until you decide to cancel it. Brokerages normally have a max time limit though, so you're best checking this with your individual broker. Then we've got day, and if you don't specify a good till cancelled instruction, then the order will typically be set as a day order. This means that if the order isn't filled within the trading day, the order will expire and you'll have to re-enter it a day later. The next order type is all or none, or AON. This order type requests that you get the entire quantity of stock you requested or none at all. This can be handy when a stock is illiquid or a limit order is used. Say you want 100 shares of a stock and the stock's at $800, but only 50 are being sold, then your order will not be filled until there are at least 100 shares available at your stated price. Another order type is immediate or cancel, or IOC, and this states that we want whatever amount of an order that can be executed in a short space of time, often seconds or less, and then just cancel the rest. And if it's not executed immediately, then just cancel the order. And this can be either a market or a limit order. And another stock market order type is fill or kill, or FOK. This is a combination of all or none and immediate or cancel. So basically, here we are saying we want our entire order size and in a short period of time, otherwise just cancel it. So to sum it up, as you can see, the three main order types to be aware of are market orders, limit orders and stop orders, and everything else is really just a combination or variation of these. Knowing which order type to use and when can help save you time, money and reduce risk. There are times when one stock market order type may be more appropriate than another. Longer term investors may just go for a market order, as the decision to invest is based on fundamentals and the investor may not care about slight price fluctuations but rather the long-term price. A trader, on the other hand, is likely to be more focused on short-term prices, so a limit order with a stop loss may be used. As always, if you're starting out, it's best to practice with a demo account and to do your own research in case your brokerage does some slight variation. But anyway, I hope you enjoyed this Investing for Beginners video. If you got this far, then you are a legend. If you enjoyed this video or got any value from it, then I'd really appreciate you smashing the like button and let us know below whether you mainly use market orders, limit orders or stop orders and why. I'd love to know, and I read all your comments. And if you want to learn more about personal finance, saving money or investing, I have loads of videos on my channel, so I recommend you subscribe and press the bell icon so you don't miss out on any future updates. It's been Ollie from Get Geek Finance. Thanks for watching and I'll catch you in the next one.